Hello everybody, this is Ray and let's talk about the Fed. There's a lot to talk about the Fed. I'm going to hit on two main parts. The main goal of the Federal Reserve is to maintain stable prices and promote maximum employment. This dual mandate prevents the Federal Reserve from raising rates too high or dropping rates too low. If it's too high, businesses will halt expansion plans and won't hire a lot of people. If it's too low, businesses will be able to expand and hire more people, and consumers will be able to borrow more money for vacations, houses, cars. Sounds great, right? Near full unemployment and borrow money for whatever you want, except that producers can't keep up with the additional demand created by the consumers. So they have to inflate prices, thus creating inflation. So this is a very delicate balance. And when you hear rates have dropped to zero, this is not your mortgage rate. This is the federal funds rate, or the rate that banks loan money to each other for overnight loans to meet the Federal Reserve requirement. You see, whenever you give $1 to a bank, they're required to keep a small portion or a reserve of that dollar in the bank. Then they can loan the rest of the money out to someone else. So your money's not actually in there. Well, not all of it. The bank lends it out to Joe for his house, or the Kennedy's house, or Miss Maitland's house, and 100 others. The banks lend them out the money, and they pay it back plus interest as they can. That sounds kind of familiar.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here.
So if the Fed wants to encourage banks to lend more money, they'll start buying back bonds or mortgage-backed securities from those banks, giving them a credit. The banks can use this credit to meet the reserve requirement, giving them more money to lend out. And they have some options. As we discussed earlier, banks can lend to each other overnight and make interest. However, if that Fed funds rate is low, then they can make far more money lending to consumers or businesses to buy all the stuff that you want. But what about your mortgage rate? As the Federal Reserve buys back all of these mortgage-backed securities or bonds, it increases the demand and keeps the yield, or the money made off of these treasuries, low. I know, I kind of have to think about this backwards, but the more people that want to invest in something, the less you have to give them to invest. So the Fed is increasing the demand for the bonds, keeping the money made off of those bonds, or the yield, low. And these bonds are tied directly to long-term, fixed interest mortgage rates. So now you can have a lot of fun with your friends, dreaming up wild scenarios of what might happen in the economy and how you can use the federal funds rate and the buying back of bonds to stabilize prices and maximize employment.